Hi guys, and welcome back to the rest of your exam paper questions for 2020 that I'm working through with you. So in the Collab the other evening, earlier this week, I went through questions 1 to question 3, and that recording has been uploaded for you. So basically today going to go to question 4. We'll have a quick look at question 5, which is the last question in the paper, but that is almost identical to a similar question that we've already done in the 2018 paper that I uploaded for you. So I'm not going to spend too much time going through that one again, but we can have a brief look at it as well. I don't want to bore you with long recordings of stuff that you've got repetition of. Although repetition is not a bad thing, because repetition and practicing is exactly how you memorize and get familiar with these questions, so that you can do them in an exam when you get similar questions. Okay, so I'm going to share my screen now and then go through question 4. So remember, this is the 2020 exam paper. What do I want? Screen, share audio. Okay, so in a second you should see the kaleidoscope, and then I'll go to the okay, let me just double check my microphone. Okay, that is working properly. Here we go. All right, so let's have a look at this. This is a 40-mark question. It's a really nice question, and this question really tests your understanding of certain principles. It comes from Learning Unit 5, Share Valuations. And if you look in your textbooks, you've got question 5.2 in your textbooks. And this question is very similar to question 5.2. Basically, it's the same question, just worded slightly differently. Similar to question 5.2 in the textbook. So go and have a look at question 5.2. You've got the solution to that in your textbook, and then that will also give you another question to practice with these same principles. Okay, so we wish to value the shares of Sunwolves Pty Limited, which is currently unlisted. So unlisted means that the shares are not publicly traded. It's a privately held company. So Pty Limited means it's proprietary limited. The shares of the company are held by a specific private group of individuals. So these guys want to list publicly. So they want us to value the company so that we can then determine what the share price should be, what is called the initial public offering. And I'm sure you've heard this term, IPO, initial public offering. So when a company sells their shares on a stock exchange for the very first time, that is called an initial public offering. And of course, because the shares have never been publicly traded before, there is no historical market share price. So when that share is first, I don't know if you've seen also on some of these movies and that they show you when a share is going to be listed for the first time, people stand at the top of the like a balcony, and they ring a bell, and then that shares then starts trading for the first time. We have to have a price at which we first offer that share. So it's the opening price that that share is offered at. So in this question 4, this is exactly what we're going to be doing. Value the company so that we know more or less what the share price should be when we first offer it in the market. So the company's only other sources of capital, so remember, capital are the sources of funding that the business uses to grow and expand and run the business, are corporate bonds. So bonds, remember, are similar. It's a type of a loan instrument with a current market value of 3 million rand, that's in total, and then also convertible preference shares of 5.25 million. So preference shares, again, that's a specific type of share that's sold only to a specific number of people, and they also then would have sold those shares privately to raise funds. So those are the two sources of funding that they've got up to now, but now they want to publicly trade. So the information that we've got is we have forecasted the free cash flow. So remember the free cash flow, if you go to your textbook with the free cash flow valuation model, that starts on page 134 in your textbooks. Sorry, it doesn't start on page 134, it starts before that. It starts on page 130. So go and revise on page 130 to the top of page 131 what the definition of a free cash flow is and how we calculate it. Remember, that's where we take EBIT and we make some adjustments to EBIT, and then we say, okay, so this is the amount of free cash flow that the company is generating through their operations on an annual basis. So in the next financial year, which is going to, in this case, be 2021, so the year that has not yet taken place, they forecast, so that's predict, that the free cash flow will be 975,000. So that is like saying the cash flow for year one will be 975,000. After that, the cash flow is expected to grow at 8% per annum for the next 4 years. So year one, it's going to be 975, then it will grow at 8% for another 4 years, which will take us to the end of year 5. Year one plus another 4 years growth, we'll have 5 years worth of cash flows. After those 5 years, which we call the initial period, cash flows are then expected to increase at a constant growth rate of 2%, less than the initial growth rate. So if our initial growth rate is 8%, the constant growth rate after that, where am I at? If the initial growth rate is 8%, the constant growth rate after the first 5 years is going to be 2% less than that, which means the growth rate into perpetuity is going to be 6%. So from year 6 onwards into infinity, that is what the growth rate will be. In other words, what we know in our formulas, what we call the terminal value. Then they give us two pieces of information. The WACC, which is the weighted average cost of capital, is 15%, and the cost of equity is 18%. So remember our weighted average cost of capital, and you'll do this in the first learning unit in your second semester, doing calculations. How do you calculate what the weighted average cost of capital is for a company when they've got 4 or 3 or 4 different sources of funding? So weighted average cost of capital means with all the sources of funding that I've got, which in this company's case is preference shares and bonds, the average cost of capital is 18%. But the cost of equity, which is only the cost of, what would that be? The cost of the actual shares in the business, or the cost of the dividends that they have to pay the shareholders, that is 18%. So again, if you go and have a look, this is very important that you know the distinction between, in this question, do you use the WACC of 15%, or do you use the cost of equity of 18% to discount your cash flows to calculate the present value? So in this specific method, free cash flow valuation method, because we are valuing the entire company as a whole, we use the weighted average cost of capital. Whereas in the previous methods, such as the dividend growth method, we use the cost of equity or required rate of return as the percentage to discount those cash flows. Because what we're valuing in the dividend growth model is only the price of one share. In other words, we are valuing the equity only. So therefore, we must use the cost of equity to discount those cash flows. When we were using the free cash flow model, we are valuing the entire company, including both debt and equity. So that's why we must use the weighted average cost of capital. So read through that section in the textbook and make sure that you understand that that is specified in the textbook as well. Students often get caught out with that in questions, because in this question, unlike question 5.2 in the textbook, they've given you both WACC and cost of equity to test whether you know which one of those two you must use. So if you can't reason it out, you'll be lost and you'll just have to guess. If you go and have a look at question 5.2 in your textbook on page 135, you'll see that they only give the WACC in that question. So your exam questions always test your application of your theory as well as the questions that you've practiced. So first of all, then, for 10 marks, they want us to calculate the current value of Sunwolves using the free cash flow valuation method. So take note also, what they've said here is what we will calculate is the current value of the entire PTY Limited. They didn't say calculate the current value of a share. It's calculate the current value of the company. And that's important that you know that free cash flow valuation method, that is what we calculate with this method, is the entire company valuation, which includes both the debt and the equity value of the company. Okay. So one other thing I want to just show you here, if you go and you are, I'm hoping, using your formula sheet to practice these questions with, you will have noticed that in your formula sheet, you have got on the second page of the formula sheet, just under CAPM, you've got the bond valuation formula, you've got the dividend growth model, constant growth model formula, and then underneath that, you've got the variable growth model. And then underneath that, you've got the little formula for calculating the rand value of the free cash flow, but they have not given you the free cash flow valuation formula. So again, if you haven't practiced with your formula sheet, this is going to panic you when you get to this question in the exam, because you're suddenly going to realize you don't have that formula in front of you, and perhaps you've forgotten to memorize it or to know what to do when you get asked this question. So there is a bit of a cheat that you can do, and that is that you can use on your formula sheet the variable growth model, because you are basically doing that identical calculation in the free cash flow valuation method. So let me just go to the formula sheet and find that for you. Here we go. So here is the variable growth model. So this formula that's on the formula sheet calculates PO. So PO is share price of one share. But the way that we calculate the price of one share is to take the initial growth period of the dividends that the share is paying out and value the present value of that, and then add to that the present value of the terminal growth period. So this is exactly the same thing that we're doing now, but instead of D for dividends, we have got free cash flow. but we're also going to calculate the present value of the initial growth period for the free cash flow. So formula identical, excepting for DO, we are going to use FCF. And the same thing over here, terminal value of the free cash flows, and then we present value them. So you don't have to panic that the FCF valuation model is not on the formula sheet. You're just going to use this. And remember, I told you for your assignment that you must use the, I don't have it right here in front of me now, but you must use the format of the answer that if you go back to the recording that I did of the work through of assignment 2's answers, you will see exactly what the layout and the format of your answer should be for this type of question. And you're going to use that identical layout for this free cash flow valuation. Remember, guys, difference between free cash flow, which this one over here, the answer is the rand value of the actual annual cash flow, okay, versus a free cash flow valuation model, which calculates the total value of a company as a whole, both debt and equity. Excuse the spelling there when I'm typing, okay? This is one of the common mistakes that students make. If they see a question and it says free cash flow valuation, they come to the formula sheet, they use this formula here, and this is, of course, not a valuation formula. It is the formula for calculating that rand value of the annual cash flow. This is the one that you used in your second assignment. Okay, so let's go back to our question 4. So here's the information that they've given us. We don't need that first bit at the moment. We only need to know that 975 for the next year, then it's going to grow at 8% for another 4 years, and then after that it will grow at 6% into infinity, and that the WACC is 15%. That's the information that we're going to use. So here is our answer, and this is what I meant by the layout. So we need 5 years worth of initial growth period. So you write one row or one line per year. You're going to start out with, they said 2021, it will be 975. So we don't need to make any adjustment to that 975. That is year 1. Remember, year 1 as opposed to year 0. Oh, wrong one. I want that one. This is year 1. If they had have said to you the last free cash flow was 975 and they expected to grow in the next 5 years at 8% per annum, then for year 1 you would have taken 975 plus the 8%. But in the question they told us next year it is expected to be 975. You've got to read the wording and these explanations with understanding and with discernment so that you don't make these common errors. So then from year 2 all the way up to what is going to be year 5, we then take 975 and we grow it by 8%. Add 8%, and then we take that amount and we add another 8% and that amount and another 8% and so on. So you could use this method that they've got where they've got 975 times 1.08 to the 2, or you could have just said 975 grow it by 8, and you could have then said 1053 times 108 and then 1137 and so on. It doesn't matter what your mathematical method is, as long as you get to the right answer. And most importantly, you are going to show all of your calculations on the paper that is going to be marked. Very, very important. So here you can see these calculations have been written out in full, and they must be so that you can get those marks. In these financial calculations, when we've got to forecast cash flows into the future, we always only forecast the next 5 years, and thereafter it's normal practice to then just do some kind of apply some kind of a blanket percentage from year 6 onwards, because it's kind of like you can't call it a fact, but it's a known practice in finance that we think that we can reasonably forecast the next 5 years, but anything beyond that is too far in the future to have any kind of a certainty, and that's why we then apply some kind of a general percentage. So we've got our 5 years cash flow. Then for year 6 to infinity, I had one of the students writing on one of the papers to infinity and beyond, which I really loved because Buzz Lightyear is one of my favorite characters. So we don't do financial forecasts beyond infinity, but yeah, we can. It's good to think about those things. So to calculate that, we took year 5's Rand value there, and we grew that by 6%, because remember the terminal value from year 6 onwards, we said that the cash flow, the free cash flow, is going to grow by 6% per annum. So this part of the formula here is basically your perpetuity formula. I don't know if you remember your present value of a perpetuity. Present value of a perpetuity is equal to, we take the PMT divided by R, and that gives us the present value. So our PMT in this case is going to be the Rand value of the cash flow that we receive constantly year after year after year, which remember is the characteristic of a PMT, in other words, an annuity. And then divided by R is then going to be the interest rate or the return that we are getting. So in this case, when we are this part over here is the same as our dividend growth model, which instead of PMT over R, for valuing a share, we say it's D1 over K minus G. So with this one, instead of D1, which is a dividend, we are saying it's the free cash flow over K minus G. So the last free cash flow, the 1,326,477, which was year 5, we want to know what year 6's cash flow is. So this times 106, that calculates year 6's cash flow. So year FCF divided by K, which is our WACC, minus G. And remember, this is our basically G2, which is the second growth rate into infinity. And then this over here was our WACC. So WACC minus G2. And then because this part of the calculation here, FCF divided by WACC minus G2, that would give us the present value of the free cash flows from year 6 into infinity. We then want to present value that amount to today's money, in other words, to the present value. So this is basically the value as at the beginning of year 6. We want to know what its present value would be over here at the beginning of 2021, which is why we then multiply that by 0.497, which is the same present value factor that we used for year 5. So I'm breaking this calculation down a lot for you here because I want you to really understand what it is that you're doing in these calculations, because that makes it, as soon as you understand them, it makes it much easier to work out in a question with the information that they've given you, what you're supposed to do with it, and to identify in the case study that they give you what all the different amounts and stories that they've told you what you're supposed to do with them, if you know exactly what's represented by each of these amounts in the different formulas. So we need to present value each of those years. So WACC of 15%, and this would then be year 1. So your quickest way to get this factor is to use your tables, which these tables are probably going to be sideways up. Let me just, oh, sorry, I went the wrong way around. Sorry, guys. Just see if I can find those tables. We want the present value of a lump sum table. Oh, they are the right way around. Good. That's an future value of annuity, present value of R1. Okay, so this is the one we want. The heading. Present value of R1 for n periods. So always make sure you know your headings of your tables, and we have got a WACC of 15%, and for 1 period through to these 5 periods here. Okay, so here are our values that we want. Use your tables, they will be given to you, and then you can quickly, but make sure you again that you've practiced with the tables so that you know that you're looking up the correct factor, and then that's going to save you a lot of time. Okay, so that's where you found your, where we found those factors that we're using in the answer. You can also use your calculator. That obviously would take you just a little bit longer, and you also stand the chance of perhaps making a mistake. This would then be your present value factor formula here would be 1 plus R to the power of 1 for year 1, and then 1 plus R, sorry, and that must be to the power of -1 because it's a present value factor. And R in this case is 15%, so 1.15 to the power of -1, and that gives you the 0.87. 1.15 to the power of -2 to the power of -3, -4, -5. That would be your other method of calculating these factors if you're not comfortable using the tables. Then we multiply the 975 by the factor, and we get the present value of year 1's cash flow, and so on and so forth. Calculate the present value of each of the year's cash flows. We add them up so that we've got the present value of the initial 5 years, and then we do our second calculation here to get the present value of the free cash flows into infinity. We add the initial period to the value to the terminal period value, and we get our total estimated value of the company. So have a look at that rand value. It's 11,519,029 rand. So that shows you that that's not the value of one share in the company. That is the total value of the debt and equity of this company. So we've said this company, Sunwolves, if you were to sell this entire company to Elon Musk tomorrow, you would ask Elon to pay you 11.5 million rand, and then he can buy this company. That's essentially what we've worked out here. And we've worked out the value based on the assumption that the free cash flows are what the owners of the company have got at their disposal to grow their equity. And so that's why we've said that that's what the equity, the total company, what the total value of the company is worth. Because remember, our profits, free cash flow is basically the profit figure that we've just adjusted slightly. And the profit that we make, we use that to pay off debt at the end of the year, to hold some money as retained earnings to grow the company into the future, and also to pay some of it out as dividends to the owners. So that's what the free cash flow is going to be used for, and it's why we use it to value the company. Then in question, let me also just quickly show you the financial calculator version, because we've been working with these financial calculator methods in a while. You still have to do these calculations to get your cash flow amounts, and you still have to write down your formula to get the value of the terminal amount. Remember over here, this is year 5, and this value here is year 6. Where is that? Year 6 onwards. So you'd still have to do those same maths, and then you could enter these into your calculator to get this total present value here. And what you would do then is okay, I beg your pardon, guys. Something went into my throat there for a second. Okay, I can talk to you again. Where were we? Over here. So entering into the financial calculator to do this, you would take 975, enter it into the calculator, and then press the ENT, enter. Sorry, I did have that on capitals, and then press the enter. Let me put it there, and then press the enter button, which has got underneath it, it's got ENT on the button, and underneath it, it says data. So we are actually entering these as our data amounts. And then you would go 1053, and then press ENT, and 1137, and press ENT, and so on. So each of these 6 amounts, you would then enter. And then when you got down, when you'd entered all of those amounts into the calculator, when you got to the bottom over here, you would then enter second function key, press the CFI key, type in 15, which is our percentage, and then press that data key again, enter. That then tells the computer that 15% is the percentage that we're using to discount these cash flows that we've entered. And then you press the down arrow, which I don't know, I haven't got a down arrow on my keyboard here. So I'm just going to write down arrow. And then you press the comp button. You don't have to type in PV, you just press the down arrow, hit the comp button, and this answer will appear on your screen. Okay, but yeah, so this obviously saves you calculation time, but not really in this question, because you still have to calculate each of these different cash flow, each of these different cash flow amounts. Remember, this is what we're entering. These are the amounts here, 975, 1053, 1137. These are the amounts that we are entering into the computer. And then we are entering in the 15% and then calculating this total present value at the end of the day. So in this second bit over here, this part in the red square brackets is how we calculate the 16,949. Okay, in other words, we calculated this value and we did not present value it. So you don't multiply it by the 0.497 because that's the present value function. We just want the actual cash flow amount. So again, if you sit with these two and understand the difference, it also helps you to understand these calculations really well as well. Okay, so there we have calculated the value of the company. Also take note, I've done a long discussion about that, but that's deliberate because I'm trying to use this question to then teach you all kinds of principles and things you need to remember and why we use certain things that we do in the calculation and not just merely give you the maths of the calculation. This question is 10 marks, so you have only got 10 minutes to get that all down on the paper and move on to 4.2, where you have got 6 minutes to then calculate what is the price per share. If this is the value of the company, what would one share be worth? That's a question mark, by the way, if we were going to issue 150,000 ordinary shares. Okay, so now we have to convert that total value of the debt and equity of the company into a per individual share price. So again, go back and have a look at what they've told us here. They've said the company's other sources of capital currently are corporate bonds with a value of 3 million and convertible preference shares with a value of 5.25 million. So those two amounts currently form part of the capital value of the company. And we've got to take that into account because all they've asked us to value here is just the share price. So the share price is working out the equity portion of the company valuation and then dividing that by the number of shares. So let's go and have a look at those workings. We are taking the value that we have got from 4.2. So you must use your answer from 4.2 as your starting point, which is the total debt and equity value of the company. And then from that, we're going to deduct that debt portion. And that will leave us with the rand value, which is then the value of the equity of the company. Do you guys understand that? Total value of the company, debt and equity. So then we say, okay, we know that debt is worth 3 million of that 11.5. We know that the preference shares are 5.25 of that 11.5. So that leaves us with 326,929, which is the value of just the equity on its own. So then if we divide the equity by 150,000 shares, that means each individual share is then worth 21.79. So there we have now arrived at, when this company is initially listed, we should be able to get a minimum price of 21.79 Rand per share if we are to sell these shares at their current reasonable value. Because remember, a share price, if you own a share in a company, that represents your share of the equity in the company. Okay, and remember equity from your accounting equation. Assets is equal to owner's equity plus liabilities. So if we want to work out how much the owner's equity in the company is, we take assets minus liabilities. So that's what we've done here. This here is then basically the net asset value. Sorry, it's the net asset value. So in other words, it's the value of all of the assets in the company. So if we take the total asset value and we subtract the liabilities, according to the accounting equation, that then gives us the value of the equity. So that's the principle on which these questions are based. Stuff that you've learned right from first year accounting. Then question 4.3 and 4.4, I'm not going to go through here because those are both theory questions. For 4.3, one of the directors questioned why we didn't use the price earnings valuation model. So in your own words, explain what the PE valuation model is. So a definition of it, how do we calculate it? What's the formula for calculating it? Also explain how you will calculate the PE ratio of a company. Take note, that's the PE ratio that you learned in second year finance when you are provided with the earnings attributable to shareholders and the number of shares in issue, as well as the market price per share. So they've basically given you the answer here. But again, take note, answer what they've asked. So they've said in your own words, okay, over here, number one, oh, wrong one. Because number one, explain what the price earnings valuation model is. And then we've got here also, so number two, explain how you will calculate the PE ratio when you've got blah, blah, blah. So make sure you answer both of those parts to get all 6 marks. And then 4.4, one of the company advisors has indicated that instead of listing on the JSE, because remember they're listing because they want to raise funds, they can also consider making use of a private placement to raise the necessary funds. So in your own words, explain to the board of directors what a private placement is, and that's for 5 marks. So you have got 5 minutes to give me 5 facts to explain what a private placement is in order to get all 5 of those marks. These are all learning objectives out of the learning unit. So if you go to your list of learning objectives at the beginning of each learning unit in your module outline or on Learn, in that learning unit section on Learn, there you will find exactly what theory questions they are going to ask you. And then 4.5, the following balances appeared in the books of Broke Limited, Land and Buildings. So remember in the book, so this means these are the values from our trial balance. Land and buildings, machinery, inventories, trade receivables and trade payables, other payables, cash and cash equivalents, bank loans, and ordinary shares. So this is when these ordinary shares were initially issued. They had been issued at 5 Rand per share, which is how they ended up in our books at 5775. Because remember, when we initially sold these shares, and if they were sold at 5 Rand per share, our journal entry would have been debit bank account with the 5775 that we were paid for the shares, and we would have credited share capital. That's how this amount ended up in our trial balance. A professional valuer has provided the company with the following liquidation percentages. So these values are expressed as a percentage of the carrying value, also known as the book value of our assets and liabilities. So trade receivables, inventory, land and buildings, and machinery, all of those are not expected to yield book value, they're either going to be more than or less than the book value. Or in other words, they are worth, in real terms, if I was to liquidate the company. So liquidate the company means to sell all the assets of the company, settle all the liabilities of the company, and then see if I had any cash left over. So in other words, basically sell up the entire company to turn it just into cash that is then distributed to the shareholders. So using the information provided, calculate the liquidation value per share. Again, they didn't say what's the liquidation value. They wanted the liquidation value per share. So make sure you do that, of Broke Limited. So first of all, in this question, they've given us the TB with the current book values. They've given us the percentages of the liquidation values, but they did not tell us how many shares there are in the company. So how are you going to calculate, or where are you going to find out how many shares are in the company so that you know how many shares to divide the total liquidation value over? Think about that for a minute. How are you going to work out how many shares you need to divide the liquidation value over? So if you remember over here, they've given you the ordinary share capital as a total value, but they did tell us what each one of those shares was worth. So your calculation will be to take that 5775 divided by the 5 rand, and that will tell you that was the number of shares that they initially sold. The students continually get tripped up on these little calculations here. Okay, these are just common sense things. There's nowhere in the textbook they're going to teach you how to do that. They just assume that these are logical, common sense little calculations that just applying what you know. How did we arrive at the 5575? So therefore, if I divide it by the 5 rand, I can arrive at the number of shares. If I take my number of shares and multiply it by 5 rand, I can calculate what my total capital is, vice versa. Okay. Excuse me. So we can then go and apply that over here. Have a look at the calculations. The percentage that they gave us for land and buildings was, what format did I think they said it was 150%. So the land and buildings are worth more than current book value. Trade receivables, which is the money people owed you, if you had to collect that all in right now, you would only be able to collect 60% of that debt, 330,000. That's an asset, so those must be positive figures. Inventories, you've probably got some slow moving and obsolete stock, so your inventories from a liquidation point of view is only worth 600,000. Your machinery, for whatever reason, the current book value, perhaps there is some kind of deterioration in the machinery, and the machinery isn't worth what the book value is, and if you have to sell it quickly, you would only be able to realize 500,000. Cash and cash equivalents will be exactly as per book value. Trade payables, did they give us a different percentage for trade payables? Oh, they didn't. Sometimes they will actually give you a different percentage for your payables as well. In this case, our payables and other payables and bank loans are all as per book value. Remember to put liabilities in brackets, and your assets must be positive, so that when you calculate the liquidation value, that value is assets minus liabilities. Then we've got our total liquidation value divided by the number of shares, which we calculated as I showed you just now, and that gives you the liquidation value per share, which is what the question actually asked us. So if you had finished your calculations here at the 7105, you would be losing 2 of those 13 marks because you didn't answer the full question. Okay. So this question 4 is a really good question. I really like it. It's you practice a lot, you learn a lot about all your work in this particular question. Then, as I said, for question 5, I'm not going to work through this whole question now because we've already done similar questions in your 2018 paper, and you have got these in your textbook as well. Literally the identical question. It's a company that want to increase their production capacity, so they are going to purchase a new machine. So just take note, they want to increase their production capacity. So they've got machines that they already own, and they're going to buy a new machine to add to the machines that they've already got. Cost of the new machine would be 750,000. Delivery costs will be 10% of the purchase cost, and then also they have to pay an additional import duties of 55,000. So you need to know from your accounting inventory module how we calculate the depreciable value of machinery when we purchase it. And they've got to always give you this information. It's got a capacity of 60,000 units per annum, and it can be used for 3 years, and then at the end of the 3rd year it will be sold for scrap value of 185,000. So the 185,000 is then its terminal value, or its recoverable amount at the end of its use, at the end of its useful life. We've got existing machines, and they've got production capacity in total of 75,000 units. So anything over and above 75,000 units in terms of our demand will be met by the output of the new machine only. So in other words, the first 75,000 units we'll make on our existing machinery, and then anything more than that we will make on the new machine, but bearing in mind that the new machine can only make 60,000 units. So our total capacity has been increased from 75,000 plus another 60,000. So our new total capacity is 135,000 units. We can't make more than 135,000 units. So here we've got the list of the demand, forecast demand, 142,000, 135 and 105,000 we've got for the 3 years. Okay, so you can see by this that we can't make 142,500 units. We can only make and sell 135,000 units. Okay, and here again, you've got to read the language very carefully. Remember, in terms of year 0, year 1, year 2, you've always got to look at what is the time, the timing of the cash flow that they're describing to me. So they said management has estimated if the new product were to be sold to customers today. So today is time 0. Okay, present. It is already the present. It's not the future, not next year when the machine is working. It's today, present, time 0. It would have a current, and they repeat that, a current selling price of 50 Rand per unit and a variable cost of 40 Rand per unit. So again, you know, in order to calculate your contribution margin, we take selling price minus variable cost equals contribution margin. That you should know backwards by now from 2nd year finance. Price inflation is expected to be 5% per annum for your selling price and 3% per annum on variable costs. So inflation means from year 1. So remember, at year 0, our selling price is 50 and our variable costs is 40. at year 1, the selling price will be 50 Rand plus 5%, and the variable costs will be 40 Rand plus 3%. Fixed overheads are anticipated to increase at 4% per annum each year, but only from year 2 onwards. So in year 1, the fixed costs will be whatever they are, whatever the amount is that they give us now, and fixed overheads are expected to amount to 40,000 in year 1, in the first year. So they've given us year 1 value for fixed costs there in that 40,000. Okay, they've given us year 0's selling price and variable costs, and they've given us year 1's fixed cost. This is, make sure you understand what I'm saying. If you don't understand what I've explained here about these timings, then send me a message and please ask me. It's very important you understand this, otherwise you're going to get all your calculations wrong. The manufacture and sale of the new product will give rise to an additional working capital requirement. So we also, besides investing the money into the machine that we're going to buy, we also have to invest extra money into our working capital. So what's your working capital? Your working capital is all of your current assets and current liabilities. So that means inventory, debtors, and current payables will all increase as a result of expanding your operations. And we have to find the money to fund that increase in working capital. So we need to know what cash flow we require to increase that working capital. So management's indicated that based on the historic trends of the company, the working capital requirement at the start of each year will equal approximately 2% of sales linked to the production from the new machine only for that year. So you have to work out what is the Rand value of our production at sales value for the new machine. So you have to work out how many units will I make on the new machine, what is the selling price or sales value of those units, take 2% of that amount, and that is then what our working capital requirement will be at the start of each year. Okay, so again, read this very carefully, and you need to have practice questions like this so that you're used to this, you've seen it before, and you don't waste time, because with this question, we have got 45 minutes. It's a lot of calculations and a lot of tables and stuff that you've got to lay out, and you can't waste a lot of that 45 minutes in just trying to puzzling out what they're telling you here in the question. You must already know, okay, I've seen that before, I've practiced this, I know what I've got to do, and then just go, go, go. In addition, the company pays corporate tax 1 year in arrears. So remember, I told you this in the question, I think that we did before. The tax was paid in the year in which it arose. In this question, we are paying the tax in arrears, which means that tax from year 1, the tax expense from year 1 will be paid out in year 2. So the tax is always paid out 1 year after the expense arose. That's important when we've got to do our cash flow table, because you'll do a calculation to say how much was the tax expense from year 1, but then in the cash flow table, you will put that amount of tax under the year 2 column, and the tax square or block under year 1 will be blank. Corporate tax rate, ignore VAT. Capital allowance is going to be 40, 20, 20, 20. Capital gains is 80% implies inclusion rate. The company uses their WACC to appraise capital investment projects, and their WACC is currently 14%. Remember, we always use the WACC when we are going to work out the present value of cash flows generated by any of our projects. So very important, guys. These instructions are important. You must round off all calculations to the nearest rand, except for, and this is important, where you've got to do a price calculation. In other words, your selling prices and your variable prices. There you must keep it as 2 decimals. Otherwise, you won't be accurate. All right, that's important. You must follow instructions. So what do we have to do here? For 13 marks, we have to calculate the working capital requirement, because we need that information to then plug into the rest of our question. So first of all, what is the working capital requirement for each year for the new machine? Remember, it's going to be over the 3 years. Calculate what the rand value of the initial investment is for the new machine. Okay, total investment that the company has to make in order to purchase this machine. Then calculate the operating cash flow. Cash flow. So not taxable profit, but how much cash is actually going to flow in and out of the company. That relates to the new machine for years 1 to 3 only. So 25 marks. And then bit of a theory question at the end. What type of capital expenditure will the acquisition of the new machine be classified as, and provide a reason for your answer? So 2 marks. Name the type and provide a reason for your answer. Okay, so let's go and have a look at the workings. First of all, what are the working capital requirements? What's the rand value of the initial investment? And then what are the operating cash flows for that machine going to be? So the first one is the working capital requirements. Remember, the working capital requirements are going to be using the number of units that the new machine is going to make, 2% of the sales value of those units. So the first thing we have to calculate is what are the number of units from the new machine. So remember, total number of units that's forecast, minus the number of units that will be made by the existing machine, which means the balance will be made by the new machine. But take note, we have left that at 60, because remember, the new machine has got a maximum output of 60. Then in year 2, it's 135, the total forecast, minus the old machines, what the old machines are going to make, gives us the number of units made on the new machine. And then total forecast reduces in year 3. First 75 will be made on the old machine, so we only have to make 30,000 units on the new machine. Then they said we want 2% of sales value. So we now have to work out what is the sales value of these number of units. So we have to work out the selling price. So remember, currently the selling price is 50 Rand, but that is going to increase by 5% per year for the next 3 years. So 50 plus 5%, 52.50. 52.50 plus 5% and 55.13 plus 5%. So we've got our selling prices for the 3 years, multiply the number of units, multiplied by the selling price, gives us our total sales value for each of the 3 years. Then multiply the total sales value by 2%. That gives you the working capital for each of those 3 years. So they said the working capital, look at the wording again. Where was it? Additional have indicated based on historic trends the working capital requirement. So in other words, they didn't say the incremental working capital, they said the working capital requirement. That's also important, because then that means basically the total working capital requirement at the start of each year, our total working capital will be equal to 2% of the sales for that particular year. Okay, in the previous question that we've looked at, that question said the incremental working capital was XYZ. There's no incremental word being mentioned here. So don't go and calculate incremental just because you've seen that somewhere else. You must calculate what this question is asking for. You really have to keep your heads on squarely and work out, read carefully and do exactly what this question is asking you. Okay, you guys understand the difference between if they had said the incremental working capital and the wording for this one, which said the working capital. So at the beginning of year one, we want 63,000 Rand additional working capital. So our cash flow out at time 0 will be 63,000, because at the beginning of the project, we have to have an additional cash flow out of 63,000 to establish this new working capital that we need. Then at the beginning of year 2, the working capital needs to be 66,156 in total, which means we've got to increase the working capital by another 3,156, which is the current 63 minus the 66 total that we want. And then at the beginning of year 3, the working capital only needs to be 34,728, which means the 66,156 that we've currently got, we need to reduce that to 34,728, which means that we'll be able to release cash flow out of 31,428. So take note, at the beginning of year 1, it's cash flow out. At the beginning of year 2, it's cash flow out. At the beginning of year 3, it's cash flow out. And then at the end of year 3, it is cash flow out of the remaining balance of the working capital. So you must get those brackets, cash flow out and then cash flow in, correct, so that when you plug this into your cash flow forecast, it all works out. So do you guys understand also the timing that we have got for these working capital? So remember, at time 0, because at the beginning, that's got to happen at the beginning of year 1, that the 63,000 must be paid out. And the beginning of a project is always time 0. When we say year 1 or at year 1, we mean during the year or at the end, by the end of that current year. Okay, so make sure you understand that. And again, practice doing these questions yourself without looking at the solution, so that you get the workings correct and you get these timings and amounts correct as well. Then the second one said, what's the total investment? So the cost of the machine, 750,000, plus the delivery costs, which is 10% of the purchase price, and the import duties are directly attributable costs to the purchase of the machine, so they will form part of the initial cost of the investment. Okay, so that must be included. And then they asked us calculate the initial investment. So the initial investment, the total initial investment for the new machine. So this here is the investment for the actual machine itself, and then part of the initial investment is our additional investment in working capital. So in total, we have to invest 943,000 total initial investment. And these working capital requirements have come from here. So remember, they said initial. So initially, at time 0, what is our investment? 63,000. So it's just that year 0 that we've included there. They've just repeated these workings over here, but that's the same workings that we did here to calculate that 63. You just take the 63 from question 5.1 and you'll get those marks. And then question 5.3, what is the cash flow? So take a note at these marking instructions here for the person who's going to be marking your paper. Award the method mark if the selling price as calculated in question 5.1 was correctly used. So in other words, you're going to use your workings from question 5.1 and 5.2 to plug into your answer to 5.3. If you've gone and done the calculation, you won't get those method marks because they want you to understand the flow of these questions. If students have used previous, okay, and yeah, so in other words, if you didn't apply that 3% variable cost increase correctly, again, you're going to lose method marks. Again, number of units, you've got to get that correct. Fixed costs, again, you've got to get the timing of those fixed costs correct. In other words, in year 1, you're going to use what they gave you, and only from year 2, you're going to increase it by 4%. Your tax calculation, you can do it separately and then make sure you put the tax cash flow under the correct year, which is going to be in arrears. It must be in arrears from a cash flow point of view. Okay, and again, you must use your working capital requirements from question 5.1 correctly. Flow direction, which means indicating that where it's a cash flow out and where it's a cash flow in, has to be correct, otherwise you'll receive no marks. So these brackets or no brackets is very important because you have to show when you do the cash flow calculation here for 25 marks, if it's cash flow in, no brackets, total contribution. If it's cash flow out, fixed overheads, capital allowance, etc., working capital flowing out, your brackets have to be the right way round. So this last table is then the operating cash flows. So operating cash flows, remember, always over here, we are looking for our contribution, which is going to be selling price minus variable costs equals our contribution margin. So selling price, we calculated in the workings above, multiplied minus the variable costs per unit. And remember, taking inflation in the correct year into account, what's the contribution margin per unit? And our operating cash flow in is going to be the difference between the selling price and the variable cost. So you must get the number of units for the new machine only. And then total contribution. Then we minus our fixed overheads from the contribution, and that then, if you were doing accounting, contribution margin minus fixed overheads then gives you like your net contribution or your net profit. Then in order to calculate the amount of tax that we owe from the profit that we've got after deducting the fixed overheads, we then have to deduct the capital allowance. And that will then give us our taxable income. So your capital allowance is only going to be on the purchase price of the machine plus the delivery costs plus the import duties. So the machine will cost us 800, or should I say the depreciable amount of the machine is 880,000. 40% in year 1, 20% in year 2, and 20% in year 3. So we deduct that in order to get the taxable income so that we can then calculate the rand value of the tax. So this 80,000 is going to be 28% of year 1's taxable income. This 152 over here is 28% of year 2's taxable income. They only asked for 3 years worth of cash flow, so you did not have to show year 3's tax, which would be paid in year 4. But just pay attention if they only ask for 3 years, or sometimes they want you to do all that extra year's cash flow as well, showing the tax cash flow for that 3rd year. Okay, so make sure you understand this tax paid in arrears. Then that gives us income after tax. Then we add back the capital allowance, because remember, capital allowance is a non-cash flow amount. It's an accounting adjustment. It's not actual cash that went out of our bank account. So we're going to add that back again, exact same amount that we deducted there, we add back again to get the actual cash flow after tax. Then our last bit of cash flow that happened was the working capital. So remember that initial 63,000 took place in year 0, initial cash flow out. So this is year 1, 2, and 3. So if you go to our cash flow calculations, it's these cash flow out and in and in. It's these 3. This one over here, we already included when we worked out our total initial investment. Okay, make sure again you understand that the timing of where you put these workings into the cash flow table, super important to get full marks. Cash flow out, cash flow in, and then we can add up finally to get our total final operating cash flow generated by the purchase of the new machine. All of that was for 25 marks, so you have to be able to get this down in 25 minutes. One thing I want you guys to take note of is look at how this has been beautifully, clearly laid out on the answer sheet. We've got columns clearly divided. We've got them labeled clearly, and each row of workings is clearly labeled with what it is that I am presenting on that year. This means that whoever's marking your paper can clearly follow your thinking process. You can follow your thinking process so you don't get lost halfway through your workings and then have to go all the way back to the beginning again because you can't remember what you did. And also all workings are shown at every step of the way. So you're either going to show new workings here or you're going to refer to workings that you've already done from a different part of the question. Okay. You guys got that? Really nice question. I know I said I wasn't going to go through it all, but there were some parts in this question that I realized were different to the one we've done before. And then this gives you a clear example of 2 different ways in which they can ask the same question just by changing the timing of the inflation or timing of the working capital or the timing of the tax payments, etc. So that you remember you keep your eyes and ears wide open and you know what you're looking for. Okay, guys, the very last question was just a theory question. They said, what was it? What was the purpose? What type of CapEx is it? And why did you decide that? So it's expansion CapEx. And we decided that because they told us that the machine was specifically purchased in order to increase the existing production capacity. And that's all that you have to state there to get those 2 marks. So remember again, I'm going to finish off here. Remember again, when you are doing an exam question paper, you could have 4, 5, 6 different questions on the paper. Always in those 15 minutes of reading your paper, go through and choose which question you know really well and that you know you can do quickly in the number of minutes allocated to that question or less, and you do those questions first. So you what's the word? Put your questions in the hierarchy, number them. I'm going to do this one first, then this one second, then this one third, then this one fourth, and do them in that order. But just bearing in mind, I had one student ask, if you're going to do question 7, you're going to do question 7 first. On your question paper, you will still head it question 7 because it is question 7 from the paper, and then question 7.1, 7.2, etc. And then underneath that, you might decide to do question 3 second, but you will still label it question 3. You're free to do that question 7, then question 3, then question 1, then whatever. Just number the questions exactly the same as they're numbered in the paper, but you can do them in any order. Okie dokie, guys. And again, please remember, as I've showed you here, this formula sheet is very important. You must work with it while you revise now so that you are used to working with it. You see it's got no keys included. Some things are on the formula sheet, some things are not on the formula sheet. You will only use the formula sheet up as far as the end of the PE model there. And all of these other formulas here are everything below this is going to be semester 2 formulas. Okay, everything under. So that's as far as you have to work with. All of the rest of this we'll do next semester. Okay, guys, wishing you the very, very best of luck with your revision. And I hope it all goes smoothly. And remember, very important, ask me questions. That's what I'm here for. Thanks, guys. See you soon. Bye.